Welcome to the Wealthfinity channel. Today, we will be delving into the world of finance and economics, as we explore the complex relationship between inflation and interest rates. This is a topic that is crucial for anyone who wants to understand how their money and investments are affected by changes in the economy. We will be taking a closer look at what inflation and interest rates are, and how they interact with each other, in order to provide a comprehensive understanding of this important issue. So sit back, grab a notebook, and get ready to expand your financial knowledge with Wealthfinity. Inflation and interest rate are two key economic concepts that are essential for understanding the performance of financial markets and the value of money over time. They are closely linked and can have a profound impact on a person's financial well-being. In this video, we will explore the difference between inflation and interest rate and what you need to know about each of these concepts. Inflation refers to the rate at which the general price level of goods and services is rising and, therefore, the purchasing power of money is falling. It is measured by the Consumer Price Index, CPI, and is typically reported on a yearly basis. When inflation is high, it means that prices are rising rapidly and the cost of living is increasing. On the other hand, when inflation is low, it means that prices are stable and the cost of living is relatively stable. Interest rate, on the other hand, refers to the cost of borrowing money or the rate of return earned on an investment. It is the amount charged by a lender to a borrower for the use of money. When interest rates are high, it means that the cost of borrowing money is high, and the return on investments is also high. When interest rates are low, it means that the cost of borrowing is low, and the return on investments is also low. The relationship between inflation and interest rate is complex and interdependent. In general, central banks use interest rate policy to control inflation. When inflation is high, central banks may raise interest rates to slow down the economy and reduce inflation. Conversely, when inflation is low, central banks may lower interest rates to stimulate economic growth and boost inflation. For investors, understanding the relationship between inflation and interest rate is crucial. When inflation is high, investments in bonds and fixed-income securities may not provide a sufficient return to keep pace with inflation. In such cases, investing in stocks and other assets that are expected to grow in value can be a better option. On the other hand, when interest rates are high, the cost of borrowing can become prohibitively expensive, making it more difficult for individuals and businesses to borrow money. Inflation and interest rate are two important economic concepts that are essential for understanding the value of money and the performance of financial markets. By understanding the relationship between inflation and interest rate, investors can make informed decisions about where to allocate their assets and how to manage their finances. If you want to stay on top of these key economic indicators, be sure to stay informed and seek out the guidance of a financial advisor. Inflation refers to the rate at which the general level of prices for goods and services is rising and, subsequently, purchasing power is falling. Central banks, such as the Federal Reserve in the United States, use various monetary policies to control inflation rates. A low inflation rate is generally considered good for the economy as it helps keep prices stable, which leads to more predictable spending and investment decisions. On the other hand, high inflation rates can cause prices to rise rapidly, eroding the purchasing power of consumers and businesses. Interest rates, on the other hand, refer to the cost of borrowing money. When interest rates rise, the cost of borrowing increases, and when they fall, the cost of borrowing decreases. This directly affects the borrowing and spending patterns of individuals, businesses, and the government. For example, if interest rates rise, consumers and businesses may be less likely to take out loans, which can slow down the economy. Conversely, if interest rates fall, consumers and businesses may be more likely to borrow and spend, which can boost the economy. The relationship between inflation and interest rates is complex and can be both positive and negative. In general, when inflation is high, central banks raise interest rates to combat it. The logic behind this is that higher interest rates make it more expensive to borrow money, which reduces demand and slows down the economy, effectively slowing down the rate of inflation. On the other hand, when inflation is low, central banks may lower interest rates to stimulate the economy and encourage spending and borrowing. In addition to affecting inflation and economic growth, interest rates also have a direct impact on the value of money. When interest rates are high, the value of money tends to increase, and when they are low, the value of money decreases. This is because people are more likely to hold onto their money when interest rates are high, as they can earn more money by keeping it in a savings account. Conversely, when interest rates are low, people are more likely to spend their money as they are not earning much by keeping it in a savings account. The interaction between inflation and interest rates is complex and multifaceted. Both have a direct impact on the economy, and the decisions made by central banks in regards to these indicators can have far-reaching consequences. Understanding the relationship between inflation and interest rates is important for anyone who wants to make informed financial decisions, such as investing in stocks, bonds, or real estate. By staying informed about the current state of inflation and interest rates, you can make decisions that will help secure your financial future. In conclusion, inflation and interest rates have a complex relationship that can have significant impacts on the economy. When inflation rises, central banks often respond by increasing interest rates to control the rise in prices. Higher interest rates make borrowing more expensive, which can slow down spending and curb inflation. On the other hand, low interest rates can stimulate spending and lead to higher inflation. Understanding how these two factors interact is important for individuals, businesses, and policymakers to make informed decisions and prepare for potential changes in the economy. It's important to remember that inflation and interest rates are just two of many factors that affect the economy, and that their relationship can be influenced by other factors such as global events, changes in government policies, and shifts in consumer behavior.